Today we're going to chat a little bit about natural gas, specifically natural gas futures. We're going to chart, and then we're going to talk about how to play natural gas using options with limited and low risk. Or this is, for full disclosure, this is for educational purposes, not an official recommendation, but just want to open everybody's eyes to the possibilities of option trading and what you can do to mitigate risk while still leaving plenty of profit potential. Regardless, whether you're trading futures or options or a combination of both, there's substantial risk of loss in trading futures and options. It's not suitable for everybody. Although the oil and natural gas futures face vastly different fundamental stories, they do have a few aspects in common. For starters, we've seen oil and gas drilling rig counts drop like a rock in recent months. In fact, we're seeing levels not seen since the financial crisis, and the rigs are dropping offline faster than we've ever seen before. In theory, that should offer at least some sort of floor under both natural gas and crude oil. Although we've seen crude oil move substantially higher, natural gas has yet to follow, but we have reason to believe that maybe natural gas will eventually follow. Possibly not to the quite the magnitude that we've seen in crude oil, but in theory, like I mentioned, we should head the path of least resistance is higher. Let's put it that way. Also, the dollar rally, which has been resiliently hanging out up in the high 90s, 100 area, is finally showing signs of cracking. If the dollar weakens, that'll be bullish for commodities across the board, including natural gas, as well as stocks and some other asset classes. So if you happen to be long commodities and or stocks, you're probably rooting for the dollar to weaken. I know I am. So this is a monthly chart of natural gas. Now keep in mind, because futures contracts expire, when you're looking at monthly charts or weekly charts, there's some guesswork to be had. And this is because as one contract expires, the weekly chart has to pick up. It's basically charting multiple contracts in a nutshell. They call these continuous charts, and they're not perfect, so it takes some guesswork. For example, if you look at natural gas prices currently, you'll notice the front months are trading well under $2. The back months are trading in the mid $2. In some cases, there's $1 in between the prices in the front month versus the back months. This is called contango, and it's normal. It's at a bit of an extreme, probably because contango generally accounts for the cost to carry, how much money it costs to store the commodity between today's expiration or the front month expiration and an expiration in the future. But in today's world, when we're dealing with COVID shutdowns, questionable demand situations, and that sort of thing, there's probably some fundamental pricing built into contango. In other words, the market's probably expecting demand to be a little more robust later this year than it is now because of COVID-related issues. So with that said, we're seeing extremes when it comes to contango. Nevertheless, we've noticed that natural gas tends to be extremely comfortable between $2.50 and $3.50, which if you're looking at, for example, the November contract is trading at about $2.40, $2.50. If you're looking at the front months, we're trading in the 170s. So in any case, we should, in theory, expect natural gas prices to at least trade sideways and maybe even trade higher to get back up into that expected range. Most of you have probably noticed the exchange has raised margin dramatically on energy products, mostly crude oil, but also natural gas. Whether you're trading futures or options, the margins have become much higher. Also, brokerages aren't allowing low margin day trading in the energies for the most part. Some are, some aren't. Most aren't, I would say. But with that said, and also in addition to margin obstacles, let's put it that way, there's also the fact that trading energies right now is relatively risky, and nobody wants to jump off the cliff and risk their trading account on a speculation in oil or natural gas. So one idea that we've been bringing to people is the use of option butterflies. Because volatility is high and the expectations of volatility are so high, the options are priced in a way that you can construct a limited risk, low risk spread that has a massive profit potential payout. Now, obviously there's no guarantees the spread's going to pay out, But the odds aren't bad, and I'll show you an example. Again, this is for educational purposes. It's not an official recommendation or anything like that. I just want to show you what's possible. This is a call butterfly or a call fly, depending on who you're talking to. The idea is you purchase a November 250 call, you sell two November $3 calls, and you buy a November 350 call. Because you're buying and selling the same number of options in the same month and same type, there is limited risk. This spread can probably get filled somewhere around $900. So if that's assuming that's the case, if you buy this spread for $900, the most you can ever lose is what you pay for the spread plus your transaction costs. So a little over $900. No matter what happens, if natural gas goes to zero or below, you only lose your $900. If natural gas trades sideways to higher, you could make some decent money. And here's why. The profit range on this particular trade is roughly 260. We'll say 260 because remember it's costing us $900 or so to get in. So our break even's at about 260. If the market trades anywhere between 260 and 340, the trade makes something. If the market's at $3 at expiration in November, you're going to pick up the entire difference between 250 and $3 minus what you paid to get in. So we're looking at about roughly 4,000, maybe a little more depending on where you get filled. So in other words, you're risking $900 to $1,000 to maybe make as much as $4,000. That's not a bad risk reward ratio. And all that really has to happen is for natural gas to come back into that long-term comfort range that we were pointing out. Of course, it doesn't have to, but if it does, you could make some money. Now, keep in mind, if natural gas is at 270 at expiration, not $3, this trade would only pay out about $1,000. But even that's not such a bad ordeal. And of course, the spread could expire worthless. If natural gas is below 250, you lose everything you spent on the spread. The negative of a trade like this is, for starters, you're kind of locked into the spread. You can't get in and out of this very easily. So for example, if you get in today and natural gas rallies to $3 by tomorrow, you're probably not going to see much of a profit because your short options will explode in value. There's going to be a lot of time left on the trade, so you're not going to see much there. That's going to be pretty depressing. However, in the long run, this is a really great way to get your foot in the door without betting the farm. Also, the other downside is if you're too right, if the net price of natural gas rallies above 350, the spread doesn't expire worthless, but all the options are deep in the money. And when it comes to expiration, they're all assigned futures contracts, which offset each other. So you basically lose what you paid to get into the spread. So in other words, if natural gas is below 250 or above 350, you lose everything, which is 900-ish plus transaction costs. So again, for educational purposes, this is just a good, solid strategy to get into a market that's highly volatile. And I mean, to put this into perspective, if you wanted to purchase the 250 call outright, trust me, you'd be spending a lot more than $1,000. I don't have the prices in front of me, but you're probably looking at more like $3,000. So it's a way to get into the market on a discount. If you're interested in learning more about these types of option strategies, we do have a new book coming out. It's titled Trading Commodity Options with Creativity. It will hopefully be out later this summer. It's in the editing process now. These things take time, and honestly, this book took much, much longer than I ever anticipated, but we're proud of it. I think we did a good job. It just, talking about options or writing about options is really a tough game because you can go into rabbit holes and it's hard to get out sometimes, but hopefully we've simplified everything and included it in this book. So if you're interested, keep an eye out for it. If you're interested in learning to trade futures and options and you're looking for a good brokerage service, DeCarly Trading, that's who we are. We are located in Las Vegas, Nevada. We offer anything from broker assisted to discount online trading and everything in between. And if you're looking for general commodity trading information, analyzing the markets, putting a trading strategy together, Higher Probability Commodity Trading is another book we're proud of. You can find it on Amazon or any other major book outlet. And again, we're DeCarly Trading. We hope to hear from you soon.